This video comes highly requested, and today we are talking about risk management. For most of us as forex traders, we hear a lot that you should risk only about 1 to 2% of your account on a single trade. And that's difficult, especially if you're trading a small account. Risking 1 to 2% may not be adequate, especially if you don't have a lot of funds. It's not going to be possible, really, to even trade with just a 1% risk, and you may need to scale up your risk a little bit. The most important thing, however, is that you should know the exact percentage of your account you're risking on a single position. So if you're scaling it up to say 5%, you know that you're risking 5% on every trade, or depending on what you decide. But if you're risking 5%, you know that if you have 20 consecutive losses, your account is done. You're blowing that account. But if you're risking 1%, again, it would give you more room, that you need 100 consecutive losses before you'd blow that account. So it's important to know exactly the percentage you're risking and what that percentage translates to in terms of cash. So if you're risking, say, 3% of your account, you know that it's an X amount. So this amount is what you are potentially going to lose if this trade goes against you. So before you enter that trade, you know this predetermined amount, that if this trade hits my stop loss, I'm losing X amount of money. So if the trade starts going against you, you don't start to panic because you're afraid of how much money you're losing. You should have that predetermined before you enter any trade. Now, a little difficulty that we face is how to actually calculate in terms of cash that 1 or 2% that we are risking on a single position. And there are a lot of calculators out there, risk calculators on the internet if you Google it. But I personally use the Baby Pips position size calculator. I was introduced to that by Jeffrey Benson, and it has been so helpful in my trading. What the position size calculator will allow you to do is that you can choose your account currency. In this instance, you're using the US dollar, and then you can put in how much your account balance is. I want to use $1,000 as an example. So if you're trading $1,000 account, you want, let's say we are risking 2% of our account, so that's the risk percentage, 2%, and then our stop loss. So depending on your setup and the stop loss that you have predetermined, let's use a stop loss of 25 pips. Now you choose the currency pair that you are actually trading. So in this case, let's use the Euro USD as the currency pair. Now, if you hit calculate, it's going to give you the results of this potential transaction, and that is what you should use to trade. So in this instance, your amount at risk is $20. So you are risking $20. So worst case scenario, if your trade hits stop loss, that's $20 that you're going to lose. Now your position size is going to give you in units, in trading units. We'll go into that maybe another time, but then that's 8,000 units that you're that's the trade you're taking. And then it's going to give you, if you're using a standard lot, mini lot, micro lot, what you should be trading with. I think most brokers and most people I know would be using a standard lot. That's what I know. But so typically you'd be putting on 0.08 lots that of a standard lot, 0.08, and that's what will give you this $20 as your stop loss. So if you're taking the trade, it means that you're going to put 0.08 lots. That's what you're going to trade in order to risk $20 on a single position. So this is very easy and very convenient, and it's a very useful tool for any forex trader. It helps you to know how much risk you want to put on the table, and it's very important in order to preserve your capital. Now, in trading, the most important thing is not profit, but capital preservation. The profit is a plus. So anytime you are trading, remember that you want to protect your capital with all that you can. What I usually do is, so that I don't typically maybe spend too much time when I'm doing my analysis on the charts, I kind of try to put in different stop losses, potential stop losses, 3 or 4. So if my stop loss is 20 pips, my stop loss is 25 pips, my stop loss is 30 pips, I would already calculate that in relation to my account balance at the time and just leave that on my trading view, so that I know that automatically once I want to enter the trade and I know that my stop loss is 30 pips, then I know that this is the position size I should use. So it actually speeds up my decision making before I enter my trade. That's just personally something that I do. The last thing I want to briefly mention is the importance of trading with a high risk to reward ratio. Now, please listen to me. When it comes to risk to reward ratio, there are a lot of divided opinions about it. Some people believe that, a win is a win, a loss is a loss. If you made something, it's the most important thing. At the end of the day, the money is important. That's true, because even when you have a potential risk to reward ratio that is high, it doesn't necessarily mean that the market is even going to hit your potential profit level. But it's important to have a risk to reward of more than 1:1. Personally, that's what I've come to realize, and that works for me. It's important that when you do that, it's going to give you some more room for error in your analysis and in your trading career. So I'm inserting this snippet. So in this instance, as you can see here, if you're trading with a risk to reward ratio of 1:3, that means that if you lose 7 trades out of 10 and only win 3 trades out of the 10, that is a confirmed 1:3 risk to reward ratio. That means that what we are saying here, if you've risked 1% of your account, if 1% of your account on every trade, and if the trade goes in your favor, you're going to get 3%. If you have 10 trades and you lose 7 out of them, just winning 3 trades out of 7, winning, not breaking even. If you win 3 trades out of 7, you're good and you're going to be profitable. So in this instance, in this example that I'm showing you, that's 7 trades loss ending in losses, and then 3 trades ending in full profit of 3%, and that puts you at a net profit of 2% at the end of the day, which isn't even a bad thing to begin with. So you need only a 30% confirmed win rate, because sometimes some people break even and they consider that wins. That's not what I'm talking about. That means you have a full take profit of 3% per trade. You only need to be right 30% of the time. So that gives you a lot more room as a trader to maneuver, as opposed to trading a 1:1. If you win 1 trade, you're up 1%. If you lose 1 trade, you're down 1%. That means that you have to be right more than 50% of the time in order to be profitable. And we all know how the markets are. The markets aren't always very friendly. So if you have a high risk to reward ratio, it gives you more room that even if you are wrong, the number of times, a few times you are right, you're going to scale over the losses, the potential losses that you made. It's very important to me personally. I know realistically it's not always achievable, but if you can try in your trading to achieve that, a higher risk to reward ratio, 1:2, 1:3, I think 1:3 is the safest. That's what I personally always try to achieve, but it's also a very important point to note. All right, you guys, thank you so much for watching today's video. This video came in highly requested, as I said earlier. I hope you've learned something. If you have, please do subscribe to the channel. There's more coming in this new year. And if you've not already followed me on Instagram, please do. There's a lot of content that I'm putting out on Instagram now, and you should really, really get into it. There's a lot of educational tips and stuff. There's a lot I have in store for you guys this year. So please do subscribe, share the channel with your friends who are into trading and just want to take control of their finances. And we will see each other in the next video. So till the next time, it's the girl who trades.